What's up, everyone? Marcus here. So Congress just passed major changes to the tax code. If you're already retired or planning to retire soon, this isn't just a small update. It's a meaningful shift in how you should be thinking about your tax strategy in retirement. So we now have a new tax law that includes a lot of good news for retirees. While the motivations behind the changes may be political, with midterm elections coming up next year, the result is clear that there are new opportunities that could benefit middle-class Americans, especially those in retirement or nearing retirement. And while Congress may have not intended it, the latest tax law changes have created one of the most powerful tax planning windows that I've seen in a long time. So, from 2025 through 2028, only 4 years, retirees, they have a unique opportunity to take advantage of expanded deductions, lower tax brackets, and enhanced benefits for those who are age 65 and older. Think of it as a limited time window to reposition your retirement income strategy before tax rates shift again. So here's what's changed and why it actually matters. So first, the standard deduction, it got a boost. So beginning in 2025, this year, the standard deduction increases by $1,500 for married couples and $750 for single filers. And if you're 65 years of age or older, you get a senior bonus, right? Which is a tax deduction of $6,000 per person. And that's on top of everything else. So let's look at how this works, all right? So I'll give you an example. You got Bob and Susan, right? Both age 67. So in 2024, their standard deduction was $32,300. In 2025, this year, it's going to jump up to $46,700. So what does that number mean? Well, a retired couple age 65 or older this year, 2025, gets $46,700 in completely tax-free income without itemizing or having to come up with receipts. Now, to really understand why, we can break down how the tax formula works. So here's Tax Math 101. All right, so you start with your total income, everything you earn that year, receive that year, Social Security, pensions, part-time work, withdrawals, dividends, interest, whatever that is, right? Then you subtract any above-the-line deductions, like HSA contributions, traditional IRA contributions, things like that. What's left is your adjusted gross income, or your AGI. Now, from your AGI, you subtract either your itemized deductions or the standard deduction, whichever is bigger. And that gives you your taxable income, which is the number the IRS actually uses to calculate what you owe. So the standard deduction is the amount of income that the IRS lets you completely shield from taxes. And that enhanced senior bonus deduction that we just talked about, for couples, that means an extra about $15,000 of income that's automatically tax-free. The second change in the new tax bill is the lower tax brackets are now permanent, right? Now, everyone assumed that the Tax Cuts and Jobs Act, that they would vanish in 2025. That's when they were set to expire. That would have meant that brackets across the board would have gone up. 12% bracket would have went to 15, 22 to 25, 24 to 28, and so on. But this new tax law, it hits pause on that nightmare, right? The lower brackets are now permanent. But remember, permanent in politics means really until the next party in power decides otherwise. But for now, we get to extend these lower rates. So here's what this means in dollars. So you got Sarah. We'll say she's a single retiree with $60,000 in income. She would have faced a tax increase of about $900 per year if the old rates would have returned. Now that money stays in her pocket, at least until politicians change their minds again. But these are meaningful changes for retirees, but the planning window is still limited. Now, as I said, most of these provisions are only in place from 2025 through 2028. That's an opportunity. So if you're looking to make smart tax moves, there is a prime window for Roth conversions. Now, with the expanded deductions and lower brackets, you can shift money from pre-tax retirement accounts to tax-free accounts like Roths. You pay little or even zero tax, and you can enjoy tax-free growth and withdrawals for the rest of your life. So here's how this could play out in real life. I'll use another example. You got Jim, age 66, with $500,000 in his traditional IRA. Under the old rules, converting $30,000 to Roth would trigger taxes on that full amount. Under the new rules, if Jim converts $46,700 in 2025 this year, he pays zero federal tax on that conversion. And if he does this every year from 2025 through 2028, he could move a little over $186,000 into a Roth IRA completely tax-free. That's money that will never be taxed again, no matter how much it grows. Now, let's look at another opportunity, which is capital gains harvesting. So we got Linda, all right? We'll say she bought Apple stock in 2015 for $25,000. It's now worth $75,000, so she's sitting on a $50,000 capital gain. Now, she's been hesitant to sell, afraid of that tax bill that would follow. But under the new rules, if Linda's total income, including that $50,000 gain, fits within the expanded standard deduction and the 0% capital gains bracket, she could pay zero federal tax on the sale. Then she could turn around and buy the stock right back, resetting her cost basis to $75,000, so any future gains are measured from today's value. So that's two planning strategies that can make a big impact on your taxes. All right, so I'll give you another one. We'll call this the income smoothing strategy. All right, so let's meet Tom and Martha. We'll say they're both 68. They have $800,000 in traditional IRAs. The required minimum distributions, they're going to kick in at age 73. But waiting until then could come at a cost because those RMDs could push them into a much higher tax bracket down the road. So a smarter approach would be to start taking voluntary distributions now while they have access to this expanded tax-friendly window from 2025 to 2028. Now, by spreading those withdrawals over the next 4 years, they could smooth out their income, stay in a lower tax bracket, and reduce the size of future RMDs, or required minimum distributions, right? Which would potentially save them thousands of dollars in taxes over time. So, what's the fine print? Because there's always some fine print, right? Now, as with most tax breaks, there are income limitations. The senior bonus deduction begins to phase out at $150,000 for married couples who file jointly and $75,000 for single filers. So if your income goes above that, the extra deduction starts to shrink. And by the time you're over $200,000 if you file jointly or $100,000 if you file single, it's completely phased out. All right. So, for example, if you're married and you're earning $175,000, you'll lose about half of your senior bonus deduction, and at $200,000 plus, it's gone altogether. Still, though, for the majority of middle-income retirees, this is a very real planning opportunity that shouldn't be ignored. So, how do you make sure you aren't leaving money on the table? I'll give you an action plan. Here is an action plan. First, run the numbers. Don't guess. Don't wait for the headlines. Take your projected 2025 income and subtract $46,700 if you're over 65 and married. What's left is your taxable income. And for many, it's much lower than you probably expected. That's money that you can reposition tax-free at a very low rate. All right. Next, evaluate your planning team, right? If your advisor hasn't already brought this up, that's a red flag. Tax planning is no longer optional. It's where the real value is created. If they're still focused only on investments, it may be time to find someone who understands that tax alpha is the only alpha that matters in retirement. And then more importantly, take action, right? Just like I said, you've got a 4-year window, 2025 through 2028. You need to take advantage of one of the most, what I think, favorable tax planning periods that we've had. Use it wisely, whether it's Roth Conversions, capital gains harvesting, income smoothing. Small moves now can lead to big savings later. So the bottom line is that every now and then, Congress accidentally passes something useful, right? And this is one of those moments. But the question isn't a question of if you should take advantage of it. It's whether if you can afford not to. I probably butchered that, but you know what I'm saying. And if you're not sure where to start, we can help. If you're not a client, click the link below to schedule a planning session with our team. We specialize in helping retirees build a complete strategy, one that goes beyond investments and includes proactive tax planning, income distribution, and long-term financial security. Now, if you're currently a client, we're already looking into ways to take advantage of this opportunity, and we will discuss that with you during your annual tax planning meetings here in the upcoming months. But the sooner you have a clear strategy, the more you can take advantage of what's available. The window is open, the math is clear, but the clock is ticking. Don't be that person in 2029 explaining to your kids why you missed one of the biggest retirement tax savings opportunity in a generation, right? Because you were too distracted by the news or the noise. Act now. If you need our help, let us know. Like I said, clients were already working on the back end, and we will be ready when tax planning season starts. Until next time.